In this video, we'll delve into the specific ways the Finance Bill 2024 will affect you as an investor, so watch till the end. First, the Finance Bill proposes implementing a 5% withholding tax on interest earned by investors from infrastructure bonds, also known as IFBs. These bonds currently offer investors semi-annual interest payments during the entire duration of their bond ownership. Under this Finance Bill proposal, when investors receive interest on their bond investment, the government will withhold 5% as tax. This tax will apply to all future IFBs with a maturity of over 3 years. It's worth noting that IFBs have been tax-free since 2009, a factor that has significantly contributed to their popularity. In fact, retail investors, meaning investors like you and I, in recent years have surpassed traditional investors like insurance firms in investment in bonds. This is due to bonds offering high interest rates, such as the 18% interest rate on the February IFB, while remaining tax-free and perceived as low risk. However, with the proposed introduction of the new tax, there is a possibility that the investor interest in these bonds will decrease. Second, the Finance Bill proposes to introduce a motor vehicle tax of 2.5%. This tax is on the value of the vehicle. For example, if your current insurance payment is 5% and the value of your vehicle is 1 million shillings, your current insurance cost is about 50,000 shillings. With the additional 2.5% tax, your total insurance cost will rise to 7.5%, that is, 75,000 shillings. Keep in mind though that the max payment in the bill has been capped at 100,000 shillings. Previously, there has been no such tax in place. The only tax on vehicles has been on the point of purchase, and in the 2023 Finance Bill, a 16% VAT on motor insurance was introduced. However, VAT is only a percentage of the insurance payment, while this new tax is on the value of the car, hence a more significant impact. Shifting focus from motor vehicle owners to investors, how does this new development affect you as an investor, whether or not you own a car? The responsibility of remitting this tax to the government, according to the bill, falls on the insurer. They are required to pay this tax within 5 working days. Any insurer who fails to collect the tax will face a penalty of 50% on the uncollected value, in addition to the uncollected tax amount. This escalation in risk poses challenges for insurance companies. Defaults and late payments will directly impact their operational costs, potentially resulting in significant financial burden. For instance, if even only 1,000 owners are tardy in payment, insurance companies could face losses amounting to millions. Additionally, there is the likelihood of multiple owners opting for third-party insurance, leading to reduced revenues for insurance companies. Many of these insurance companies are listed on the Kenyan stock market. Hence, this is something for investors to look out for. Third, the Finance Bill proposes elevating the excise duty on mobile transfers from 15% to 20%. The hike applies to the fees levied for mobile transfer services, impacting all financial service providers, including banks and agencies. In recent years, there has been a trend of people returning to cash transactions due to the fees associated with mobile money transfers. With a further increase in tax, this trend may intensify, with individuals opting for physical cash to avoid additional costs. Such a shift could pose challenges, particularly for banks and companies like Safaricom, both of which are listed on the Kenyan stock market, and are heavily reliant on mobile money platforms such as M-Pesa as a primary source of revenue. These are the direct implications of the Finance Bill 2024 on investors to consider should the bill be enacted. Share your thoughts in the comments.